What's up, guys? Todd Robinson here. Listen, I wanted to make a quick video about the different types of financing that you can find in commercial real estate, but specifically multifamily investing. And before I do that, I want to make sure you like this video, subscribe, click on the links down below. Let me explain a little bit who I am. My name is Todd Robinson. I'm a real estate finance and investment expert. I have my own law practice in Atlanta, Georgia. I represent real estate investors around the country and really around the world in growing and scaling their real estate portfolio and closing billion-dollar multifamily transactions. I also have my own portfolio of over $85 million of assets, primarily multifamily, and I run a multifamily investment community for elite investors looking to really grow and scale and take action. It's called Multifamily Deal Makers. So let's get into the types of financing that is available for multifamily transactions. There's really a couple types. First, the type that is let's just say the community banks, right? If you're getting smaller deals like 10, 20, 30 unit deals that are small dollar amounts, you may want to go to like a community bank execution or perhaps what's called a credit union. You'll get decent terms, but it'll probably be a recourse guarantee. What does that mean? That means you are personally responsible for repaying that debt. It's different than non-recourse. I'll explain what that means in just a minute. So that's community bank execution. You also have what's called bridge debt. What is bridge debt? Think of it literally as a bridge from execution. You're going to implement a business plan, and then you're going to refinance into a long-term debt product. That's called a bridge product. Bridge is typically higher leverage, and you can get funds for your what's called capital expenditures, your CapEx, right? So if you're going to implement a value add strategy with an apartment building and you buy it for, let's say, $10 million, and you want to put $1 million of renovations in there. Say the units are all classic units. Actually, I do it right now. I'm looking at it. That's just like this. Every unit needs an upgrade. Kitchens need upgraded. Paint, we need carpet. We need different lighting. We need backsplashes, things like that. We need to improve the playground. So all of those things. Fannie and Freddie, which we'll talk about last, they really won't pay for or fund properties like that. So you'll have to get bridge debt. And these days, bridge debt will come in with at least 80% of the purchase price, which is a high leverage, which is okay. It's good debt, right? And 100% of the CapEx. So think about this. If you're at a $10 million property, your loan's going to be $8 million. Plus, let's say you're going to get $1 million of renovations. They're going to fund $8 million of the debt, $1 million of the renovations. They're going to give you a $9 million loan. Now, that $1 million when you close doesn't go into your pocket, okay? It actually gets reserved by the lender, and then the lender doles it out as you do the work, right? As you submit invoices for payment. Okay, so that's how bridge debt work. It's short term. It's usually a year to 2 years. Can be also interest only. Typically, it is interest only, right? Because it's just serving a purpose. The purpose is to get you from A to Z, right? Now, the last type of financing there's other types, but the most prevalent type is called Fannie Mae and Freddie Mac. And you've probably heard of these quasi-governmental organizations. And they are exactly that, quasi-governmental organizations. They're kind of funded and backed by the government, but they're kind of run privately. And they have a mandate to fund multifamily housing. Their rates are typically lower because they look for stabilized assets. So you need to have what's called 90%. Your property needs to be 90% occupied for at least 90 days. And if you meet that criteria, then you can apply for Fannie Mae and Freddie Mac financing. Now, they do require these days more experienced operators. So that can be a challenge. You may have to partner with some people for some strategic partnerships, right? But that's another prevalent type of multifamily debt. It's really the best type of debt out there because you can really get high leverage and low rate. Bridge debt, which we talked about a minute ago, is typically high leverage, but also higher rate. It's going to be a little bit higher than Fannie and Freddie, or a lot higher depending on who the lender is. These days, we're talking 7, 8, 9% interest for a bridge loan. I have a connection for a lender that will do in the sixes, which is amazing. Fannie Mae is in the fives, right? 5.5, 5.25, depending on the size of the deal. So that's Fannie Mae and Freddie Mac. There's also something called CMBS, commercial mortgage-backed securities. Now, you may have heard that term from the downturn, right? 2008, 2009. Gosh, can't believe how long ago that was, almost 20 years ago. During that time period, you had what's called residential mortgage-backed securities, and that is how the market imploded because basically all those residential loans were chopped up, securitized, turned into bonds, right? Or into trust instruments that were then purchased by investors, right? So each investor got a little piece of this bond. And what happened is that the properties were crap, right? So back then, I remember I even got a loan back in 2008 for a condo. I don't think I provided any documentation. I think I just said, yeah, I worked here. This is my salary. And they didn't ask for anything. No bank statements, no tax returns, no nothing, just an application. That was it. Actually, it was Countrywide Mortgage, I think Countrywide Financial, who went under. They were one of the ones that went under because of the financial crisis. So it was a subprime mortgage. They were giving me loans that were below the prime rate. And so when we obviously paid our mortgage, but a lot of people didn't. And when they didn't, all those defaults came due, and then the bonds were basically junk bonds, and the market imploded. So that's residential mortgage-backed securities. That's not what we're talking about. We're talking about CMBS, commercial mortgage-backed securities, right? Commercial mortgages, same concept. Commercial mortgages are chopped up, they're put into bonds and sold on the open market. Same concept. No, none of the risk that came with the residential mortgage-backed securities. CMBS loans they do like multifamily properties. So you can go buy a multifamily property with a CMBS loan, typically lower leverage, higher leverage and lower rate. Why are they better or worse than Fannie or Freddie? They're probably worse from a closing perspective. They're a pain in the butt to close, because think about it. These loans are going to be securitized. So lenders counsel is typically a sophisticated big firm lawyer, charging a buttload of money. So they're expensive, and there's lots of I's to dot and T's to cross in those deals. But you can fund hairy projects, right? Projects that have a little bit of hair on them with CMBS loans. So definitely consider that. And when you're looking at closing your first multifamily deal or your 100th multifamily deal, right? So we've got community bank execution, we've got credit union execution, we've got Fannie Mae and Freddie Mac, we've got CMBS loans, we've got bridge loans. There's another concept called hard money loans. Now, you don't really want to get into that game. Hard money loans are essentially loans that are very high risk for the lender and very high interest rate. Like people who have trouble getting mortgages regularly, people who have bad credit, people who maybe have a bad history when it comes to litigation or whatever the case may be. Hard money lender will come in and they will just look at the value of the property, and they'll say, this property's worth $10 million. You want a loan for $5 million. So the leverages are a lot lower, because they're banking on, okay, if this borrower defaults, I don't really care. I'm going to go and foreclose on the property, right? If you have to go out and get a hard money loan, you're in a bit of a predicament. It's not the best scenario, not the best situation. But regardless, they serve a purpose in the market, 100%. So it's usually those interest rates are 10, 20, 30, 10, 12, 15% interest, 17% interest maybe. Again, I've done a bunch of them as legal counsel on these deals. And again, they serve a purpose. They can kind of be rescue capital when that is needed. So so let's go through it again. We got bank execution, community bank, right? I wouldn't necessarily go big bank, Wells Fargo, JP Morgan Chase, Bank of America when it comes to closing these deals, because that's just not their bailiwick, right? There are some groups that have a lending platform for those multifamily deals, but they are hard. I've represented banks, those kind of banks, and their process is just so cumbersome. They have people working in all different parts of the country, and it's just cumbersome. So I would stick away from that. But community banks, right? Your local community banks will definitely do it. But again, you're going to sign a personal recourse guarantee. Credit unions, good. Personal recourse guarantee. Fannie Mae and Freddie Mac, non-recourse. Let me explain that. If I didn't explain that yet. Non-recourse means that if there's a default and there's not what's called a bad act, okay, which is defined within the guarantee agreement, then the lender, their only recourse is the property. So they can foreclose on the property, they can sell the property, and then hopefully when they sell it, they'll recoup everything, but they can't come after you personally. Now, unless there's a bad boy act, right? Those are called bad boy carve-outs. What is a bad boy carve-out? If you defrauded somebody, if you committed waste on the property, meaning like you just neglected it, you failed to keep insurance on the property, you failed to pay taxes, you didn't pay vendors timely. There's a lot of different things that are considered recourse guarantee triggers. So it's very important if you're doing a non-recourse deal, Fannie or Freddie or CMBS. CMBS is also non-recourse, that you review the guarantee closely with your counsel to make sure you agree with all those non-recourse triggers. Because these days, as I've seen, there are so many things that are non-recourse that you sign a non-recourse guarantee, but they very much look like recourse. Sorry, everything under the sun can become a trigger. Like, for instance, if there's a payment default, that should not be a recourse trigger. If there is uh, a vendor that's in dispute that put a lien on your property, you're disputing it, that shouldn't be a recourse trigger. Those kinds of things. So be wary of that. When you're buying your first deal, you've got your bank execution, you've got your credit union execution, you got Fannie and Freddie for stabilized deals that don't have a lot of deferred maintenance. You've got your bridge debt for value add opportunities that's going to bridge you usually from that bridge execution to a Fannie or Freddie long-term product. You've got CMBS loans. You also have HUD. We didn't talk about HUD, but HUD is really more of a long-term stabilized type of product as well, not really suitable for your first deal. And then be wary of the recourse triggers. So that is my lesson on financing multifamily transactions. Again, make sure you hit the subscribe button, follow me on Instagram, make sure to sign up for our newsletters, and I love adding value to your feed. Take care.